The euro just exploded higher by over 2%, but there's a massive trap being set right now. The 200-day EMA at 1.1630 has rejected this pair 7 straight times since 2025. With the FOMC in complete confusion, traders are about to get squeezed one way or another. I've mapped both scenarios with exact entry levels, stops, and targets. This could be the biggest move of the month, but you need the roadmap. And remember, the market always does what surprises the crowd. I've seen this exact divergence 3 times in my career. Twice it led to a violent reversal, and once it didn't, and that one time cost a lot of traders their accounts. What I'm talking about is what's happening right now on the euro to US dollar as we enter the new trading week. We just witnessed the most powerful weekly outside reversal since the September 2022 squeeze, back when the Bank of England had to step in to stabilize the gilt market. But here's the thing that has me concerned. We are sitting at 1.1562 after a massive 2.2% rally off the recent lows, and we are staring directly at the 200-day exponential moving average at 1.1630. This level has acted as a brick wall 7 times in the last 18 months. 7 times. And now, with the FOMC in complete disarray following a 9-3 voting split and the weakest US employment data since early 2024, the market is about to face one of its most consequential tests of the year. What happens in the next 5 days could determine the direction of the euro for the entire fourth quarter. My verdict for the week ahead is tactical bullish on pullbacks, but with a very specific condition. I am looking to buy weakness, not chase strength, and here's my invalidation level. A daily close below 1.1470 breaks the near-term bullish market structure and would force me to exit any long exposure immediately. I'm calling this a consolidation week with a breakout attempt, but I'm not going to lie to you. The higher we push toward that 200-day EMA without a proper retest of the breakout zone, the more nervous I get. The market is currently pricing in a more aggressive rate-cutting trajectory from the Federal Reserve following the employment data. But the Eurozone has its own problems. German industrial metrics have stabilized, yes, but we are not out of the woods. Let me show you exactly what I'm seeing across the timeframes and why I've already placed limit orders in specific zones. Before I dive into the technicals, I want to establish the fundamental context because this is the engine driving the current price action. The US dollar suffered broad institutional liquidation following significantly weaker than expected ADP and macro employment data, which came in well below every analyst estimate. What matters here is not just the headline numbers, but what they mean for the Federal Reserve's policy path. We had a 9-3 voting split among FOMC board members, and that level of internal division is something I haven't seen since the taper tantrum back in 2013. 3 members are voting for immediate rate cuts, 3 are voting for holding steady, and the rest are somewhere in the middle. This policy confusion is dampening long-term dollar demand, and institutional traders are rushing to adjust their positioning. On the other side of the Atlantic, the euro has found sturdy baseline support via robust industrial and retail metrics across Germany, which had been the weak link in the Eurozone story. But here's my personal observation from watching these currency flows for 20 years. What stands out to me is not the headline CPI or the industrial data, but the 10-year yield reaction. That's where the smart money is watching. We're seeing a divergence between the euro's price action and the US Treasury yield curve that suggests the bond market is already positioning for a full 50 basis point rate cut by September. And that brings me to the high-impact calendar events we need to navigate this week. The Eurozone ZEW Economic Sentiment Index comes out on August 11th. And that's going to give us a read on how European institutional traders are feeling about the second half of the year. But the real fireworks happen on August 12th with the US Core Consumer Price Index, the most important data point of the month. The following day, we get US retail sales and weekly initial jobless claims. This is a packed calendar, and every single release is going to move the pair significantly. So let me now take you through the technical structure that I'm using to frame all of this fundamental noise. Moving to the weekly chart, this is where the story becomes really interesting. The euro to US dollar has formed a powerful outside weekly reversal, rallying over 2.2% off its recent lows. When I see a bullish reversal bar like this on the weekly time frame, especially following a deep retracement into major multi-year support blocks, I pay attention. The monthly trend is bullish, with strong monthly demand defending those structural support levels, and this recent bounce is confirming that the bulls are still in control of the bigger picture. The weekly trend has shifted from bearish to bullish reversal, which is a significant development. Now, I want to focus on the daily chart because that's where the critical battle is taking place. The daily trend is clearly bullish, with price breaking above near-term structural resistance lines. We are currently trading at 1.1562, which is above the 5-day moving average at 1.1545 and well above the 10-day and 20-day moving averages at 1.1520 and 1.1495 respectively. The 50-day moving average sits at 1.1460, which is roughly in line with my structural invalidation level, and the 100-day moving average is at 1.1510. But the big one, the 200-day moving average at 1.1630, is the level that matters. This level has been a brick wall since March 2025, and every attempt to break above it has been met with selling pressure. The last time we closed above it was in December 2025, and that rally ultimately failed at 1.1800. So I'm watching this level like a hawk. The RSI on the daily chart sits at 62.45, which is bullish territory but with plenty of room before we hit standard overbought levels. The MACD is showing a solid bullish histogram crossover sustained above the zero line, indicating continued upside momentum. The ATR of 0.0068 is reflecting an expansion in daily trading ranges, which tells me that the market is becoming more volatile, exactly as you would expect during a transition period like this. Drilling down to the 4-hour chart, the trend is strongly bullish with exponential moving averages exhibiting a fresh bullish crossover structure. The momentum indicators, particularly the ADX at 24.10, are rising and suggesting a nascent but healthy directional trend. The CCI at 118.50 is hovering in short-term overbought territory, which favors buy-on-dip algorithms. I think we are going to see continued buying on any meaningful pullback. The 1-hour chart shows price action flattening into a minor range contraction following the late Friday momentum. This is classic consolidation behavior, and it's typically followed by an expansion move in one direction or the other. We need to watch the structural levels that are going to define this consolidation. The key support levels are at 1.1520, which is the first support level, followed by 1.1500 and 1.1470. On the resistance side, we have the structural intraday peak at 1.1588, then 1.1610, and the big one at 1.1635. The weekly pivot point sits at 1.1525, which is confluent with the 10-day moving average. Now, I want to share a personal insight here. This level reminds me of the August 2022 squeeze. Back then, the same liquidity grab fooled everyone. We had a similar outside weekly reversal, a similar approach to the 200-day EMA, and the market ended up trapping the bulls before a massive move lower. But I also remember the March 2023 situation where we broke through and had an incredible run. The difference between those two situations came down to one thing: the fundamental backdrop. In 2022, we were in a rising rate environment. In 2023, the Fed was on hold. And in 2026, we are in a pre-rate cut environment. That context matters. Now let me get into the specific trade setups that I'm looking at for the upcoming week. I've got 2 scalp setups for the 24-hour time frame and 1 swing setup for the 5-day period. Scalp setup 1. Bearish rejection. The first scalp setup is a bearish rejection play off the supply zone. If price pumps into the 1.1588 to 1.1610 resistance belt during the early European session but buying volume dries up, I'm looking to execute microshorts. The trigger here is a rejection candle pattern on the 5-minute chart, or a failure to break above the 1.1588 structural high with momentum. The entry would be around the 1.1595 to 1.1605 area, and I'm targeting a swift scale out at 1.1545. My stop loss is placed firmly at 1.1625. This gives me a risk-reward ratio of about 1.5 to 1, which is reasonable for a scalp. The invalidation for this setup is a daily close above 1.1610. Scalp setup 2. Bullish bounce. The second scalp setup is a bullish bounce off the weekly pivot. If an early dollar short squeeze flushes the index down to the 1.1520 to 1.1525 support zone, which is confluent with the weekly pivot point, I'm waiting for a 5-minute candletail confirmation. The entry would be near 1.1525, and I'm targeting a mechanical push to 1.1565. My protective stop is pinned below 1.1495. This gives me a slightly better risk-reward ratio of approximately 2 to 1. The invalidation for this setup is a 4-hour close below 1.1495. I'm going to be very selective with these scalps and only take them with clear confirmation signals. I don't chase price when it's already extended. Before I share the swing setup, I want to pause and ask you something. When you look at the euro to US dollar chart right now, what level concerns you the most? Is it the 200-day EMA at 1.1630? Or do you think we are going to see a deeper pullback toward the weekly pivot at 1.1525 first? Drop your levels in the comments because I genuinely want to see what the community is thinking. The market often moves toward where the pain is greatest, and I want to gauge the crowd sentiment. Swing setup. 5-day bullish play. Now let me break down the swing setup that I'm most excited about for the next 5 trading days. My market bias is tactical bullish on pullbacks. The structural double bottom formed on the weekly chart indicates that the path of least resistance points upward, provided key weekly support holds. I've seen this kind of weekly bottom formation before, and when it's supported by the kind of fundamental backdrop we have right now, it often leads to sustained upside. My primary accumulation zone is 1.1495 to 1.1520. This zone represents the high volume node of the recent breakout structural channel, and it's where I'm looking to layer buy limit orders during any artificial dollar strength spikes leading up to the US CPI print. I'm looking to build a position in this area, scaling in as price approaches the zone. My invalidation point is decisive and unemotional. A daily close below 1.1470 breaks the near-term bullish market structure and requires immediate exit from long exposures. This is a hard stop for the swing position. My profit targets are structured based on the technical resistance levels I've identified. Target 1 is 1.1630, which is the confluence of structural horizontal resistance and the daily 200 EMA. This is the first logical area to take partial profits. Target 2 is 1.1800, which is the major psychological milestone and midterm technical vacuum point. If we break through the 200-day EMA, the road to 1.1800 becomes surprisingly clear because there's very little historical resistance in between. I want to emphasize something that's critical for every trade setup I've just given you. Risk management is not a module you add on. It is the foundation of everything we do. The risk-reward ratios I've outlined are only valid if you respect your stop losses and manage your position size appropriately. I tell my private clients the same thing I'm telling you now. Never risk more than 1 to 2% of your account on any single trade idea, and never add to a losing position. I've been trading for 20 years, and the biggest mistakes I've seen are traders who let a trade go against them because they couldn't accept the loss. I've had positions that moved 100 pips against me before reversing, but I only held them because my analysis told me the invalidation hadn't been triggered. Here's a personal risk anecdote. I remember the March 2023 NFP event where I had a full-size long position on euro to US dollar, and the trade moved against me by about 70 pips before reversing in my favor. The only reason I held was because my stop was at 1.1460, and price never got there. If I had let fear dictate my exit, I would have missed a 200 pip move. But I was also prepared to take that loss if the invalidation was hit. That's the mindset you need. Know your invalidation, respect your invalidation, and never let a small loss become a big loss. So let me summarize the key level to watch for the week. The 200-day EMA at 1.1630 is the line in the sand. Above it, we have a clear path toward 1.1800. Below it, and we could see a retest of the weekly pivot at 1.1525, and possibly even a deeper correction toward the 50-day EMA at 1.1460. I'm leaning toward the upside, but I'm not chasing. My plan is to buy the pullbacks and respect my invalidation at 1.1470. I want to remind you that I'll be back on Friday with a live market wrap covering the US core CPI reaction, and on Sunday with the complete week ahead forecast. So make sure you're subscribed with notifications on so you don't miss those videos. In the meantime, if you haven't watched my previous video on the US dollar index breakdown and its implications for the major pairs, I'll link it in the description. The piece I did last week on the correlation between Treasury yields and the euro could be the most valuable video you watch all month. I also want to hear from you in the comments about what you're trading this week. Are you focusing on the euro, or are you looking at other pairs as well? I read every single comment, and I'll be engaging throughout the week as the market develops. Alright, that's all for now. This is Eric Trade Meridian Decoded Channel signing off. Stay disciplined, stay focused, and I'll see you on the charts.